You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have British American Tobacco, Airtel Africa, Unilever, Mony Group, Reckitt Benckiser, and our US company of the week is PayPal. Sam, shall I kick us off with British American Tobacco?
Absolutely. One of the 4 stocks that I own on this show this week.
So it's the largest tobacco company listed in the UK, and I believe it's the second largest worldwide. They had their half-year results out last week, with first half revenue down 0.8% on an organic basis to £12.3 billion, ignoring the impact of currency movements. And sales of traditional combustible products were down 2.6%, where strong pricing was not enough to counter the 6.9% fall in volumes. The lower revenues from this category were partly offset by a 7.4% increase in new categories. Underlying operating profit fell by 0.9% to £5.8 billion, in line with lower sales, and free cash flow fell from $2.3 to $2.1 billion, with the impact of the exits from the Russian operation being felt. Underlying net debt fell by 12.4% to $33 billion. And there was no change to the full year guidance. However, the group do expect to see the achievement of $5 billion from revenue from the new categories into next year being now unlikely. And they've called out a lack of enforcement against illicit single-use vapor products in the US in particular as being particularly challenging. And the shares were up nearly 3% on the news. In terms of valuation, the group has a market cap of £60 billion and trades at 7 times forward earnings compared with the 10-year average of 11.5%, and they have a dividend yield of 9.4%. I don't think this is a big surprise for us. We've covered them since we started the show. I think we've said it a few times, and we've got used to it now over at least the last 18 months, I would say, to see a more significant fall in volumes. So 6.9%, that's getting that higher single digit, has been a concern in terms of what this means for the business. And I suppose with the new categories, which includes vapor, there is an enforcement issue when it's coming to some of the illicit products. And that had been an issue, going back when there'd been the move to plain packaging and even before plain packaging with the regular combustibles, but it's now really beginning to impact on vapor. And I think as well, with with increased regulation of the vapor, then this is a disadvantage to the big tobacco companies, and could be argued particularly helps or it gives more rise to the illicit, particularly the single-use vapor products in the US. So I think there are some concerns for the business there. However, broadly, I think this is about what we've come to expect. So I don't think there are any major surprises here. And what stands out is that incredibly cheap valuation at 7 times forward earnings and a stonking yield of nearly 9.5%. I suppose you would argue what the sustainability of that is. And clearly, if you're seeing fall in your volumes of your most profitable product by 6.9%, that's pretty massive. And it's not going to take long before you really see things fall and potentially that dividend come under serious pressure. In terms of the non-combustibles, well, overall, despite the illicit single-use vapor doing well, but is it going to be enough of a future for this business? And I suppose that's the big question. And again, from a valuation perspective, and it's a comment we make every time, it's difficult to see a significant re-rating on the basis that institutional investors largely have just pulled out of it because of the ESG concerns with it. So a difficult stock to comment on in that sense, but nothing too surprising there, I wouldn't have said. Sam, do you have any thoughts on these half-year results?
Quite similar to what you said, there's nothing too surprising. I agree the 6.9% fall in volume is higher than what we've been used to seeing. However, it's been sort of 3 or 4 quarters now that we've seen this, and it does look to be the norm. I would caveat it with, a forward dividend yield of almost 10% and a PE of 7. You'd probably argue these kind of revenue drops or volume drops are what we maybe should have been seeing for a while, and it just kind of highlights how remarkable it was that they were able to keep increasing revenue for so long on those smaller drops in volumes. But if it carries on dropping at 6-7% a year, and they're carrying on raising prices, if the overall impact is sort of a 3%, 4% drop in revenue per year, it still takes a lot of years before it really, really drops. And if you're getting it at 7 times earnings and an almost 10% dividend yield, you've got quite a good chance of getting your money back before it really drops. That being said, the volume drops could accelerate. I think it's disappointing about the new categories revenue not hitting the target. And that 7% growth is lower than we've seen historically. I think blaming illicit single-use vapes is probably quite a poor excuse, really. That being said, I'm still pretty optimistic long-term about the new categories, even if they miss the target next year. I think it is something that is going to continue to grow, and hopefully it can get to a size where it can start to actually help offset, some of this drop in combustibles, which again sort of feeds back into that valuation argument that even with the 7% declines, I think it's still very, very cheap. So yeah, this is the first earnings quarter since I became a shareholder. Nothing in there that I wouldn't have expected, I would say, or that gives me cause for concern. And I'm hopeful that I can continue to get that 9% dividend for quite a few years before it comes under pressure. And by that point, I might have sort of 40-50% of my money back.
Yeah, it's interesting as well, just on, and this is sort of anecdotal on the new categories. So in terms of the heat not burn vapes, if you want to call that, but the heat not burn devices, I was in Italy on holiday a couple of weeks ago, and goodness, the number of heat not burn devices that you saw there, looked incredibly popular.
It always seems to be like that when you go to Europe, though. Whereas here, you hardly ever see them. It's more of a novelty. Everyone's just vaping.
It's probably, I don't know. It's probably a sort of cultural thing. But you imagine that those people who must be who are using those heat not burn devices are probably ex-smokers, as opposed to, even I think you notice increasing in the UK that there are young people who are vaping, and you wonder whether they've ever actually smoked and whether that's just what they've taken up, as opposed to maybe 10 years ago that they would have smoked a cigarette instead. You do wonder. I don't think anyone really at the moment has been able to say or published anything categorically on that. Interesting when it comes to the future of these businesses and what they're looking at and where it is, and I suppose ultimately how big that market can be.
Yeah. Right. Shall we move on to, another cheap business, actually?
Yeah, let's move on to it, but more growth orientated.
Hopefully. So Airtel Africa, a business that we both own, have come out with their Q1 results. And for anyone not familiar, Airtel Africa are the telecoms provider in 14 African countries listed on the FTSE 250. So revenue was down 16.1% to 1.16 billion, and all these figures are in dollars. Operating profit was down 27.4% to 335 million. Profit after tax was up 120% to 31 million from 150 million loss. Earnings per share was up from a 4.5 cent loss per share to a 0.2 cent earnings per share. And net cash generated from operating activities was down 28.7% to 414 million. Interestingly, although the revenue was down 16% in reported currencies, if that had been measured in constant currency instead, the revenue would have been up 19%. And the operating free cash flow is down 30% to 376 million. In terms of the operational highlights, the total customer base grew 8.6% to 155 million. Data customer penetration continues to rise, driving a 13.4% increase in data customers to 64 million. Data usage per customer increased by 25% to 6.2 gigabytes, with smartphone penetration increasing 4.7% to reach 41.7%. Mobile money subscriber growth of 14.9% reflects the continued investment into distribution to support increased financial inclusion across the markets. Transaction value increased by 28.7% in constant currency, with annualized transaction revenue of 120 billion. Data average revenue per user grew 9.6%, and mobile money average revenue per user grew 8.8% in constant currency to support the overall average revenue per user, which increased 9.3% year over year. Data capacity across the network increased by 33%, with the rollout of almost 3,000 sites and 5,600 kilometers of fiber. And for the revenue in constant currency growth of 19%, that was actually 33.4% in Nigeria in constant currencies and 22.3% in East Africa. Reported currencies were down 16%, as mentioned earlier, and that reflects the impact of currency devaluation, particularly in Nigeria. A substantial increase in fuel prices across the markets and the lower contribution of Nigeria to the group after the Naira devaluation contributed to a decline in EBITDA margins to 45.3% from 49.5% in Q1. However, constant currency EBITDA increased 11.3%. Profits after tax of 31 million were impacted by 80 million of exceptional derivative and foreign exchange losses arising from the further depreciation of the Nigerian Naira during the quarter. CapEx was 147 million, and that was 4.9% higher compared to the prior period. And in line with the plan, they now have zero holdco debt following full repayment of a $550 million bond in May 24. In total, 86% of their market debt is now in local currency, which I think is very good considering what is going on with those local currencies. And that's having paid down 828 million of foreign currency debt over the last year. So I think operationally, that's a very, very good move, because if they were holding foreign currency debt instead of local, the position would be quite a bit worse. Leverage is 1.6x, and that compares to 1.3x in the prior period. And of the 0.3x increase, 0.2x was due to the decrease in reported currency EBITDA. And the 100 million share buyback continues, with 21 million shares purchased for consideration of 29 million at the end of June. However, that's on a market cap of about 4.5 billion. In terms of the valuation, there is no earnings because of the issues we've been having with the Nigerian Naira. And the dividend yield is currently 4.16%, with a market cap of 4.25 billion. I think these results are disappointing. Operationally, I think the figures are very good. However, that Nigerian Naira devaluation is hurting them, as it has in previous quarters. I think this is now the third time we've seen a Nigerian Naira devaluation in the results in the last 12 months. I think at some point you have to stop classifying it as an exceptional item and it does become a normal item. And I'm not sure it qualifies as exceptional at this point, despite what they're saying, because I think 3 times out of 4 quarters, it is now a trend. That's very unfortunate. However, I think firstly, that's a risk we're taking with this business and why it's been so cheap. I think also the operational results are so good that I would hope eventually maybe it's going to tread water for a couple of years, but eventually would get to the point where even if the Naira keeps on devaluing, the growth in the other parts of the business and the Airtel money will hopefully be enough that you can still get very good returns. And I think it's now at the point where if the Naira stops devaluing, that has to be viewed as a bonus rather than part of the investment thesis, if that makes sense. I think you need to be holding it and be comfortable with the fact the Naira is probably going to keep devaluing, which, that being said, I'm fairly comfortable with, because I think as well operationally in terms of what they've done with the debt and paying all that off in foreign currency, I'm quite happy with how they're working operationally too and the investments that they're making. So for me, I'm quite happy as a shareholder. I'm not as happy as I was 12 months ago, but it's factors outside of their control and it's risks that I accepted when I bought in, and these were exactly the risks that were why it was only 7 or 8 times earnings even when it was doing really, really well. John, what are your thoughts as a fellow shareholder?
Yeah, I mean, very similar. I think we both knew what we were getting involved with here, and it was reflected in the price. As you say, operationally and historically, it has been performing very well. It's obviously a very difficult situation, and it is beyond their control. It reflected the markets they're operating in and what's going on in Nigeria at the moment. But I think the long-term trends are still positive, and we weren't buying it with a short-term view. So I'm quite happy still holding.
Should we move on to another business that you've patiently held for a long, long time?
Absolutely. It's one that has been very, very patient with it. So Unilever, they had their half-year results. We have covered it lots of times, but it's the owner of Dove soap, Hellmann's mayonnaise, Lynx Africa. It's got all sorts of different brands in the portfolio, Ben & Jerry's, Magnum, lots and lots and lots. But you can go on the website, have a look at the full portfolio. So in terms of the first half results, they had underlying sales growing by 4.1% to 31.1 billion euros, driven by a healthy mix of both price and volume growth. All business areas saw increased revenue, with beauty and well-being growing at the fastest pace. Underlying operating profit jumped by 17.1% to 6.1 billion euros. That was driven by improved margins, which landed well ahead of the market forecasts. Free cash flow improved from an outflow of 0.3 billion euros to an inflow of 2.2 billion euros, and net debt was 25.2 billion euros at the half-year mark. Full-year underlying sales growth guidance has been maintained at between 3% and 5%, and underlying operating margins are expected to be in excess of 18%. Quarterly dividend of 43 cents a share was announced, which is up 3%, and shares were up 5% on the results. So underlying volume growth was 2.6%. In terms of valuation, Unilever has a market cap of nearly 120 billion and trades at 18 times forward earnings, compared with a 10-year average of 19.1, and it has a prospective dividend yield of 3.6%. I thought these results were certainly encouraging. I think we have become used to some pretty lackluster and sort of stop-start progress with Unilever. New chief executive, I think, showing that there are some early signs of the turnaround, and particularly improving those operating margins. I think these are all very, very positive, particularly as times more recently have been difficult with cost of living pressures. And even when you look at Nestle, they're having some difficulty. So I think this is a really positive set of results. Still very early days, I think, when it comes to Unilever. And there's a huge amount of, in my opinion, a huge amount of potential that's ahead for the group. And it just needs some sort of more unlocking by the right management team. And I think probably, if you're being critical, it really hasn't had that, in at least 5 years, probably longer. So I'm cautiously optimistic about this and still very comfortable holding Unilever. But with a bit of luck, we will see this momentum continuing and hopefully gathering pace. I think you'd really like to see this business getting into the higher single digits. I think that would be, in terms of the underlying sales growth, that would be what I would see as success with the Unilever. And I think with the quality of brands, they should be able to do that. So moving beyond that sort of 3 to 5%, I would hope. Sam, do you think that is achievable? And what do you think of this set of results overall?
I think it is achievable. I think especially it's probably more achievable given that I feel like they've lagged what they could have potentially done for a number of years now. I think that's mainly been, I think, down to management, and hopefully that will be shown to be the case with the new management in and now starting to get a bit of momentum. I completely agree with what you said about it does need to go and get a bit of consistency and get some momentum, especially to justify that 18 times earnings, because there needs to be some growth to justify that. That being said, I think this is probably the most positive quarter we've covered for Unilever since we started doing the show. I can't really think of a better one, except maybe during the COVID period. I don't actually remember one being better than this, but there could have potentially been one in the COVID period, depending on what was going on with the cleaning products and stuff. But yeah, really, really positive quarter. My only niggle would be that I don't like the decision to sell off the ice cream business, especially I think when the focus of the new management is on these power brands, so the brands that do, what is it, 1 billion of revenue a year.
Yeah.
You know, the ice cream is very much part of that, and they've got some fantastic ice cream brands. So I don't know why they don't want to hang on to them. I don't get that, and I think it would be a shame to see it go. I know it depends on valuation, but would Do you think you'd be keeping the shares in the ice cream business when it's spun out?
Yeah, I would. Yeah, absolutely. I appreciate it is lower margin and that there is, the whole costs associated with, it being a frozen product and it going through the supply chain. However, I think you can do certainly more than has been done with those brands. I think they are very high quality brands. So I would absolutely be keeping, Ben and Jerry's. I think it is just Ben. No, in
They have
fact, it's the
Magnum
whole
as
thing,
well,
isn't it? Well, that's what I was wondering.
which is, probably
Fine.
two of the most iconic ice cream brands in
Yeah.
the UK. So I just don't get why they want to get rid of them.
No, that's right. That's right. And yeah, no, I must admit, I can't see it. But anyway, would you be buying Unilever anytime soon?
I don't think so. I just think it's a quality business, some quality brands. But I think that's unfortunately very defensive stock as well. But that is reflected in the valuation because I think to pay 18 times earnings for a business that's growing 4% a year, I think it's difficult.
Yeah.
I just don't think I would want to pay that.
I mean, do you think, are you more optimistic though about this turnaround? Because I suppose that's what's being
I am,
reflected to a
yeah, but
degree in
then
this.
on the flip side, we've seen that PE move from 15 to 18, so they kind of need to turn
Yeah.
around now just to justify what the shares have done. So yeah, so I am
Yeah.
optimistic. I didn't rate previous management very highly at all. I think we followed them for a number of years, and they're very uninspiring. I think the whole debacle with I can't remember the name of it,
Halion, yeah.
which we won't go into again, but didn't cover themselves in glory for that. So yeah, I'm very optimistic about the new management, but I just think, if it was at 10 times earnings, it'd be a different conversation. But I think, unfortunately, even though the performance has historically been lackluster, I think the quality of the brands is so high that it's still traded at a relative premium, albeit at not kind of prices we're used to seeing from Nestle, for example.
Yeah. So just to say as well, we didn't mention Walls. So Walls is included in the ice cream business. So you've got Twister, you've got Cornetto, you've got
Why would you want to get rid of that?
Calypso.
You kind of got the UK ice cream market locked up, really.
7.9 billion euros turnover 2023 from the ice cream business.
I just don't get it.
Yeah.
I don't get it at all.
Okay.
But anyway,
Yeah,
should we move on to Mony Group?
Yeah, absolutely. So one that you used to own, Sam.
I own it again now. I bought it back.
Oh, fantastic.
So I now am a Mony Group shareholder again. I think I bought back for a similar price to what I sold for.
Well done. Well done.
I may have lost a little bit. I'm not sure. I can go and check, but I don't want to. But I'm very happy to be owning it again. And I think it's shown in the interim period where I didn't own it why it was a mistake to sell it. But yeah, Mony Group, the owner of the website Mony Supermarket, have come out with their interim results for the 6 months ended June 24. And group revenue was up 5% to 223 million. EBITDA was up 8% to 73 million, and profit after tax was up 8% to 44 million. Operating cash flow was up 26% to 51.8 million, and net debt was down 54% to 25 million, with the interim dividend up 3% to 3.3p a share. They've said the revenue growth of 5% was supported by strong performance in insurance and cashback, and the gross margin was maintained at 68%. And the increase in operating costs was kept to 2%. Strategic achievements included growth across our member-based customer propositions with positive early indicators. They hit a milestone 500,000 members in Mony Supermarket Super Save Club, and that's up from 300,000 in April 24. And the Money Saving Expert app was named as a top 10 UK news app with over 1.4 million downloads. And they've had good member growth momentum in Quidco. They've said in the outlook they do not expect any material revenue from energy switching this year. So for the wait for that part of the business, which I think used to be about 20-25% of the business, drags on. In terms of the split by product type, the revenue for the 6 months ended June 2024 was split by, and this is on a total of 223 million. So 119 million was insurance, or over 50%, and that grew by 14%. Money was down 2% to 50 million out of 223. Home services was down 10% to 16 million out of 223. Travel was up 1% to 11 million out of 223. And cashback was up 3% to 29 million out of 223. You've obviously still got the energy that's going to come back on at some point. in terms of valuation, business trades at a PE of 14 and has a dividend yield of 5%. I think for me, I'm very happy with these results. It's a pretty solid set of results. I think they're pretty good growth figures given the valuation. I think the valuation is pretty reasonable. It's got a high dividend yield. And when you consider there's potentially still the energy switching that needs to come back on, it's kind of trading at a similar valuation to before that went off. And I know they've acquired Quidco and they've added that cashback service that wasn't there before. But I think it shows firstly how versatile the business is, in that it's got quite a few different areas where the revenue is coming from. And it's quite nicely split. I know it's more geared towards insurance at over 50%, but the rest of it's quite nicely split up. And those figures are slightly distorted by the fact that energy's not there at all at the minute. I think even if energy doesn't come back, which it kind of has to at some point, although we're not sure when that will be, but if energy doesn't come back, I still think it is a pretty reasonable valuation, given that they've shown they are able to sort of expand the business. And for example, the cashback, it's something I wouldn't have necessarily thought of, but yeah, it makes sense given the other stuff they're doing. I'm sure that management have done a very good job. I think they did a very good job in the COVID period. So I would expect them to kind of continue to grow the business and also bolt on those acquisitions that will hopefully add quite nicely and tie in quite well with the other parts of the business. So very happy to be back as a shareholder and very happy with these results. John, what are your thoughts?
Yeah, no, it's a business that I think I wasn't very appreciative of initially, and when you owned it, and I've begun over the last few years to accept the investment case, and they did remarkably well when the energy market was essentially switched off. No pun intended with that, but they did do incredibly well. And I think it's come out as a more resilient business as a result. And also, it wasn't just the energy business, but there was the travel insurance business, which again, during COVID was essentially switched off. So I think it's proved that it's very resilient. And now that things are coming back online, which includes, and going forward, going to be even more energy, one would expect. And with the margins that they have, I think it's very high quality, and it's something that I probably would look at owning. It's a business that I really have begun to like, and it's higher up on my watch list for sure. Was that what made you buy back in, Sam? It was a sort of seller's remorse over it, and then we covered it a couple of times since.
I think it was sold. I'm not really sure why I sold it. I think I must have had something else I wanted to buy, maybe.
Okay.
I'm not 100%. I can't remember. I'd have to go back and look at my transactions and figure out what I did, because I never drew the cash out. So I never actually, it's not like I needed the cash for anything. So it must have got reinvested in something else. But what it was I'd sold, there were a couple of different things that I sold recently. So including Gamma Communications, Boohoo, and maybe one or two other smaller positions. And I had a decent chunk of cash. So I just split it basically between Mony Supermarket and British American Tobacco. Since I'd sold it, obviously we'd monitored it, and I'd been completely upfront about the fact that I didn't sell it because I disliked the business. It wasn't really a reflection on the business. It's just I thought I could do better elsewhere. I subsequently didn't do better elsewhere, but fortunately the business I think went up and then came back down. I feel like I've sort of got away with it. It was at quite a reasonable price. I had some cash, and I just thought, well, I do still like the business. I kind of did regret selling. I didn't want to sell. I just wanted to buy something and needed the cash for it, and something had to be sold. In hindsight, I probably wouldn't have sold it in the first place, but I thought I should just rectify it as soon as I got the chance. But yeah, I'm very happy to be back owning it. But fortunately, all I've missed in the interim, I think, is just a few dividends, although it is at quite a nice chunky yield. So
yeah, no, fair enough. Okay, fine.
Should we move on to a business that you used to own as well?
Yes, indeed. So Reckitt Benckiser, I owned it for, must have been at least 5 years. And during that time, it didn't really do a whole lot. And it was I always felt like it was in turnaround mode, and turnaround never actually happened. So it was very much, opportunity cost. And also that I suppose I fell out of love with the business. I think the brands, we've discussed it before, but they're sort of second rate to a lot of the Unilever brands. Some of them more sort of hygiene and cleaning orientated. So they do have Finish, for example. They do have Durex. They do have Nurofen. So sort of some consumer health as well. But as I say, nothing really happened. And I think I say nothing really happened. They did have a nice boost to revenue during COVID, particularly when it came to Dettol and Lysol sales, that was a significant spike, but obviously it wasn't a long-term trend. And we can come on to discuss them, but they've had some further issues which have really knocked the share price more recently. But anyway, half-year results. So the half-year net revenue came in at £7.2 billion, and this was driven by 2.1% higher average selling prices, offset by a 1.3% drop in volumes. Underlying operating profit fell by 4.9% to £1.7 billion, and that was actually ahead of expectations. Free cash flow improved by 8.3% to £821 million, and net debt at the period end came in at £8.1 billion, and that was up £794 million from the start of the year. An interim dividend of 80.4 pence per share has been recommended, and a new £1 billion share buyback is expected to be completed over the coming 12 months. Due to extreme weather conditions impacting the nutrition business, full-year like-for-like revenue growth is now expected to be between 1% and 3% from between 2% and 4%. And Reckitt will look to sell several non-core home care brands that generated around £1.9 billion in revenue last year. And options are also being considered for the US Mead Johnson business. And cost reduction targets have been accelerated, now aiming for a 3% drop in fixed costs by the end of 2027. And shares were up 4.1% in early trading. In terms of valuation, Reckitt has a market cap of £29 billion and trades at 13 times forward earnings, compared with a 10-year average of 19.6. And it has a prospective dividend yield of 4.7%. I think there have been various changes at the top, and the turnaround efforts haven't really come through, or come to fruition, I should say. I think the other thing that is a bit of a worry is a legal case in terms of what's going on with the infant formula, and they're essentially being sued over in the States, and it's making progress through the courts. I think that's quite a big worry in terms of what it's going to mean for the company and its financial health. It is all reflected in, I think, the share price. I think the valuation, given what's going on, is fairly generous. And it's certainly not a business that I would want to be owning at 13 times forward earnings. I think that is still on the expensive side, given what's going on. I'll have to check exactly when I sold it, but I think it was around the sort of £65, £66 mark. It's currently £41, and there was a significant drop after the court issues in terms of the infant feed over in the States. And shares before that, they were sort of trading in the high 50s, and then it dropped significantly right down to sort of the low 40s. So fairly significant for a business like this. So yeah, if I were looking for another consumer goods company at the moment, there'd be a lot I would choose before Reckitt. And I think there'd certainly be a bumpy ride if you were to become a shareholder at the moment. And yes, it is a fairly decent dividend, but I think you'd want something that is got more significant growth, doesn't have the potential liabilities hanging over it, and brand's okay, I would say. But that's probably where I would leave it. Sam, what are your thoughts on Reckitt and these results?
I think the brands are good. It's a bit more like a cleaning focus, which is why it got that boost back in COVID. But there are some, obviously, you've got Sillet Bang, Durex, which is obviously a fantastic brand. But I think if you were to strip out the court case, it's fairly cheap. I think 13 times earnings compared to competitors is pretty low. Interestingly, if we're just to look at the results in isolation, they are worse than Unilever's results, given that they've not been able to increase prices and volumes, which I think is a testament to how well Unilever have done. It's nowhere near as good as the Unilever figures we've just seen. I mean, I don't know what the potential exposure for the court case is. It's not really something I know anything about, really. But if you've got that hanging over you, I do agree that 13 times earnings, although it's cheap compared to competitors don't have this potential court case hanging over them like Reckitt does. given that, I'm surprised the shares are up in trading on these results because I don't think the results are that good. And I also don't think the expectations were that low based on the price it's trading at. So I agree. I find it a bit of an odd one, really.
I'm just having a quick look in terms of the shares. I think there must have been some more updates when it's, yeah, so I think there's a slide after one of their rivals. There was a trial verdict, which has then weighed in. So yeah, the shares were on when the results came out on the 24th. They were trading at about £44 a share, and then they did drop quite significantly, well, fairly significantly, to £40 on the 29th on that news and the trial, and they picked up very slightly since then. So yeah, on their week they're down about 6%.
So it says here, I don't know where they get the figures from, but apparently the worst case scenario for Reckitt would be costs of 2 billion.
Yeah, so I suppose, yeah.
So I suppose that's a year's profits wiped out. The problem is they've already got quite a lot of debt, and that's I guess you could take the view that if they're selling non-core brands, so those non-core brands that they're selling generated revenue of 1.9 billion. So I don't know what they'd get, but if you could sell enough stuff to cover the 2 billion, that P's maybe not too bad, but it depends how much the earnings are then going to be lost. But you're getting into sort of quite a lot of nuance for a business that, you can just pay 18 times earnings to Unilever. It's definitely not the level where it's a no-brainer, even if, because I think you'd have to buy it assuming they paid the worst case scenario for the court proceedings, unless you know something about law that I don't, which is certainly possible.
Or you're just purely speculating.
Yeah, but I think you'd need to be comfortable with them paying the worst case scenario, which I mean, it doesn't like they're going to go bust, but if you have a year of profits wiped out, or you have to sell sort of quite profitable bits of the business, I just wouldn't really want to invest in a business with that hanging over it. Certainly not at that valuation. What have we got next? Should we move on to PayPal?
Yes, so this is your well, it's one of your picks, isn't it? And you've put your money where your mouth is.
Absolutely. My fourth and final business that I own this week. So PayPal's second quarter revenue was up 9% to $7.9 billion, and all these figures are in dollars, including currency movements. That's ahead of the previous guidance of 7%. The growth was driven by an 11% increase in total payment volumes, with unbranded card processing being the largest contributor. However, there was a positive contribution from all other channels apart from eBay, which now accounts for just 2% of volumes, which I think is pretty amazing considering how they started. Underlying operating income increased 24% to 1.5 billion, and that reflects both the revenue growth and the disciplined cost management. This more than offset the dilutive effect on the margins of the unbranded operation. Underlying free cash flow was up 31% to 1.1 billion, and the net cash position was 3.9 billion. PayPal repurchased 1.5 billion of its own shares and now expects the full year total to reach 6 billion, up from the previous guidance of 5 billion. So that's 6 billion on, I think, a 60 billion market cap. So that's about a 10% repurchase yield. It's just under, I think. The outlook for underlying earnings per share growth has been improved to a low to mid-teens range, up from high single digits range. The shares were up 5.1% in pre-market trading, and the business now trades at a forward P of 13, and that compares to a 10-year average of 28. I think the results are fantastic. They're far better than had been anticipated. I was quite happy with the anticipated results. I kind of thought, well, if it grows revenue sort of 7% a year, and it's increasing earnings sort of high single digits, I didn't have an issue. But yeah, these results are just fantastic given the valuation it trades at. And I think to be getting a 10% repurchase yield a year, it's at 13 times earnings, and the business is growing revenue 9% a year and operating income 24%. Appreciate some of that's on the cost side, so they won't be able to do that every quarter. But yeah, it's just for a business that's growing and putting up those kind of figures, I just think it's kind of ridiculous. And a business of that quality as well, I think to be able to get it at 13 times earnings is still pretty ridiculous, even though it's not quite at the lows it was a few months ago. John, as someone who's slightly less biased, what do you think?
Well, I'm, a little bit jealous because I think you made the case quite convincingly. It's a company I'd been switched off from and thought that it was a little bit of a relic. but I actually think you're probably right. And I think these results are really encouraging. And at the valuation, it is pretty attractive. And yeah, I'm increasingly wondering about starting a position. I don't know, though. I think we had talked more about the bear side previously. And I suppose that the huge increase in competition when it does come to sort of payments processing, and just anecdotally how much we both use, whether it's Apple or Google wallets, and how that is really significantly impacting on online shopping for PayPal. But then again, you do look at it and it's still growing. So I suppose that doesn't necessarily undermine the investment case completely, particularly when you're not talking about it being at the sort of heady heights, the valuations from post-COVID, sort of 2021. Yeah, I think it's given me one to think about, certainly, but you can't knock these results.
Yeah, I think it's important not to get anchored as well, because it's at $65 and it's up from a 52-week low of $50. Unfortunately, I didn't buy it at the 52-week low. I think I'm not up a huge amount. I think it's sort of, I'll see if I can check actually how I'm doing on it. So I'm down 2% on it. So yeah, so I've ridden it all the way down. I think I must have topped up at some point in the 60s rather than the 50s. But my initial purchase, I think, was around 70 or something. But yeah, I'm actually still down 2% on it. But as a shareholder, I'm very happy with these results. So yeah, if you did buy it as a soft blow, you would get in at the same price as me, despite not being on for a year extra.
Well, when we're talking about all of these psychological flaws that we have, it probably does, and that is not logical. But I suppose we are human, and
I think psychologically, I kind of expected to be up when I checked it.
Yeah. But yeah, so I will be keeping a very, very close eye on it, that's for sure. But I suppose I probably do need to make up my mind, and we will see.
Of the 6 businesses that we've covered this week, British American Tobacco, Airtel Africa, Unilever, Mony Group, Reckitt Benckiser, and PayPal, which do you like the most and which do you like the least?
It's quite a difficult question. I think, I mean, with my Unilever shares, I was very encouraged by the results, and I feel more optimistic than I have in a long time. But I have held Unilever for a long time, and over the years it has compounded nicely, even though it has been lackluster the last 5 years or so. If I didn't own any of the companies and I was looking to start a new position, I'd probably be tempted by Airtel. And that's knowing what I know about it, and it is very volatile, and the markets it operates in are going to be a bit of a roller coaster. But yeah, I think I would probably stick with Unilever as my first choice. But not owning any, possibly Airtel. And then last, I wouldn't go back to Reckitt. That would probably be where I'd be sitting with things at the moment.
Reckitt's quite an easy last for me, I think, especially with the lawsuit hanging over them. I think first is a tough one. Probably Airtel, although they've got a few challenges at the minute. I think operationally they're doing a really good job, and I think that's reflected in the constant currency figures. And I think it's, you keep putting up figures like that in every country. Eventually, it's just a matter of time before that does start to flow through in the results again. So I think operationally they're doing everything you could ask as a shareholder, but they can't help the countries they operate in, and that's that's part of the risk, and it's also going to be part of the reward, hopefully. But yeah, I do like British American, I do like Mony Group, and I do like PayPal a lot. And I think of the 4 businesses that we've covered this week that I own, I'm very happy with all 4 of them, actually. So yeah, it's quite nice.
Very good. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.